Hi, welcome to Market Minute. This is where we analyze the markets looking for opportunities, but most importantly, protecting our downside when we think we need to. Now, what happened over the weekend was appalling, but it really doesn't have any impact on the overall market, at least at this point. So it's all still about the 10-year Treasury. We think the 10-year Treasury yield is going to drop here, at least in the short term. So we're going to have a rally in the Treasury market, and that'll probably drive the stock market higher. It's so obvious what happened over the weekend that Iran was behind all this. Iran is important in terms of supplying oil to the overall market, but not in a real big way. They supply roughly 2 million barrels a day of a total of of exports of a total of 94 million total barrels. So we don't see it as a big economic issue right now. Israel or who they're fighting in the Gaza Strip, they don't produce any oil. So it's all about Iran. At some point in time, it could be a problem, but it's not right now. We think potentially there could be a flight to treasuries, maybe a little bit, but not overwhelming at this point. But we do think the treasuries are set up to have a nice rally, so yields dropping. In terms of defense stocks, our favorite is Raytheon. They make the Patriot missile. We like the whole defense group, but this one really stands out. They stubbed their toe on the commercial side of their business. The stock's really attractively valued. So what will China do? Not certain of any of this, right? But it seems like a distraction for the U.S. Could they move on Taiwan now? Who really knows, right? But that potential risk is out there. Now this picture is kind of cool. So this is the Iron Dome, Israelis Iron Dome. So they got 100% accuracy on all this, but they ran out of ammo, so some did go through. Now, in thinking in terms of risk management, so what's going on? We're starting to be less aggressive about it. So on Friday, we took some of our hedges off. Why? Because we see this occurring, and some of the indexes are starting to improve as well. So some of the stock index is starting to punch through some of their shorter term moving averages. But the bond market is going to drive the stock market. It's starting to break through these, the 5-day down here. And then we have the 13-day, the 20-day, 50-day, 100-day, 200-day. We really like how this is set up. We like how all the shorter term moving averages are lower than the longer term moving averages. It gives you an opportunity to invest along the way. So we think that the 10-year Treasury is set up to have a technical rally. The bond market over the long term, how does that look? Well, we think nominal GDP will be somewhere between 4 and 6% or roughly the next 10 years. If you wipe out this period right here, so the red line is the yield on the 10-year Treasury. The black line is nominal GDP. Nominal GDP is CPI plus real growth. So nominal GDP and the 10-year Treasury correlate really highly. So if you take out this, the 1970s, which was an unusual period, we're probably not going to repeat that. But if you take that out, you've averaged roughly 5% on the 10-year Treasury and nominal GDP. So our view is the 10-year Treasury will probably be between 4 and 6%. Right now, probably no more than 5. We think we're going to go into a recession next year, which means that maybe there's pressure on the 10-year Treasury yields to drop. And in the short term, as we're not in a recession yet, the market's kind of anticipating and hoping for a bond market rally. We think earnings are going to be okay to a little bit better than expected when they start to report earnings for the third quarter. This is a big point. So what's happening in the 10-year Treasury? So the black line here is the 10-year Treasury. You can see it's up close to 5%. And the orange is the amount of contracts that are short against the 10-year Treasury. So it's massive. There's a massive short position, almost as much as there is issued on that 10-year Treasury. So at some point in time, these contracts are going to have to be sold, which will push the yield of the 10-year Treasury back down. So it's really important. This could be the catalyst or not, but it could be the catalyst on Thursday when the CPI is reported. So the expectation is it comes in roughly at 0.4%. That's lower than what it was in August. The driver in August was energy. Now and energy prices were up roughly 10% in August. They're currently up about 5.8% for the month of September. Now they're roughly about a little bit below or in line to where they were in the month of August. So energy prices seem to be creeping down a little bit, even with what's going on in the Middle East. Thinking in terms of wealth management, okay, so we could have a very large move in treasury yields lower. The stock market held this 200-day moving average, and now above the 13-day moving above the 20-day moving average. So it held the 200-day, held the support line, moved up above some of the shorter term moving averages, and now it's approaching an important level, the 20-day moving average. So it too has some moving averages to break through. We think there could be a 3 to 5% move in the S&P 500 between now and year end. So it's kind of bottoming out, kind of middle of October bottoming out, which is what we said last week. So a 3 to 5% move. That's pretty attractive when you annualize that versus the short-term bond yields. So if you hold the short-term bond yields for a year, you get roughly 5%. The stock market may move up 5% in a quarter. We think it's an interesting play here, but longer term, meaning 12 months, we think that there's more downside to the overall market. Want to be cautious in general over that period of time, but we see an opportunity to make some money currently. Thank you. Hit subscribe, like, come to my website, Patrick Adams CFA, and sign up for Market a Minute to get a hard copy. Take care.